Hello and welcome to Scope's webinar today. Today we will speak about dividend strategies and what makes them attractive for investors. Performance of stock includes two components. First, the price increase, the capital gain, and then the dividend payment. And over the long term, dividends have accounted for a large part of the overall returns for investors. So for example, studies over the long term in the US market say that it was roughly 40% of returns over the long run. So investment in dividend equities is deemed to be a favorable strategy over the long term, but it not only provides the opportunity to achieve return from two sources, from capital gains and dividend payouts, but also regular dividend payouts act as a regular flow of return and can act as a return buffer during sideways or falling markets, which is also a feature that makes dividend strategies quite attractive. So today's webinar will consist of two parts. In the first part of the webinar, my colleague Runchao will present you the results of our latest Peergroup deep dive, which is our research paper we have done on the Peergroup global dividend equities. In the second part, we will speak with fund manager Ian Mortimer from Guinness Asset Management about different aspects of dividend investments. For example, how dividend cuts after the COVID crisis have affected market and fund returns. We will discuss his strategy and why it makes sense to look beyond dividend yield, and of course, his outlook on the dividend developments he expects going forward and where he sees most opportunities in the market. But before we begin, I would like to mention to the audience, that you have the possibility to ask questions to the fund manager. If you would like to raise a question, please type it into the chat window on the right-hand side, either in English or in German, and we will come back to you during the course of the webinar. But now, firstly, I would like to hand over to Runchao, who will present the key points of our recent study on global dividend equity funds. Hi, Runchao.
Hi, thank you, Barbara. Hi, everyone. I'm Runchao from Scope Analysis. Today, I will be presenting the result from the study. So I'll start with the general overview of the peer group information. For the peer group equities global dividend, the peer group index benchmark index is the MSCI World High Dividend Yield. And totally, we have 98 funds in this peer group. Among these 98 funds, we have totally 51 funds with Scope rating, and within which we have 5 A-rated funds and also 19 B-rated funds. So this is like almost 50% of the total rated funds in this peer group. So from this number, we can see that actually the performance and risk evaluation of the rated funds in this peer group is slightly centralized more to the top rather than uniformly distributed. Next, if we go to the performance number, we can see that the peer group average has a 1-year performance that is around 3% higher compared to the benchmark index. So it is for the recent performance, it's the outperformance. But on the other hand, if we take a look at the longer time period, for example, 3-year and 5-year performance, the performance number is a little bit lower compared to the benchmark index. And we take a look at the 3-year volatility, and we see that actually the volatility for the peer group average is actually exactly the same as the volatility for the benchmark index. Next, if we take a look at the oldest funds. So from this chart, we can see that we selected the top 10 oldest funds in this peer group. And by the tracking record, we see that all of these 10 funds has the performance history of more than 15 years. And the oldest one is the Allianz Global Equity Dividend Funds, which has around 25 years of history. From the number of performance, we have this conclusion that actually the age or the length of the track record of the funds in this peer group actually is not a direct indicator, or we can, in another way, we can say is not a sufficient condition for a good performance, as you can see from the number here in this chart. Next, we take a look at the asset under management of the funds in this peer group. From the result, we see that actually the asset under management for the funds in this peer group is also quite centralized to the top. We take a look at the biggest funds in this peer group, the DWS Top Dividend Funds, which has the asset under management that takes up to almost 25% of the total asset under management of this whole peer group. Similar to the previous part, the volume of the fund here, by our conclusion, actually the volume of the fund is also not a direct indicator of good performance. And here we, among all of these largest funds, actually we have only one A-rated funds, which is the Guinness Global Equity Income Funds, that has the performance, 5-year and 3-year performance, which is better than the peer group average and the benchmark index. For the next part, we take a look at the best funds. As previously introduced, we have totally 24 top-rated funds. And among these, we have 5 A-rated funds. From the result, we can see that the average of the top-rated funds has a performance that is higher than the peer group average and also higher than the benchmark index. We take a look at the volatility. The volatility is slightly higher comparing to the benchmark index and the peer group average, but the performance is higher for more level compared to the volatility. The best funds in this peer group is the JP Morgan Dividend Funds that has the volatility higher than the benchmark. But if we take a look at the performance of these funds, we can see that actually this higher risk provided by the volatility is more than compensated just by the 3-year and 5-year performance value. We can also take a look at the Guinness Global Equity Income Funds. Based on our study, the Guinness Global Equity Income Fund has the risk-adjusted return that is among the top tier of this peer group. And also, based on their strategy of the equally weighted allocation of assets, the risk of this fund is controlled by at a certain level without sacrificing the potential of reaching the high return. The last session is about the conclusion from our study. So totally 5 points. Firstly, the dividend strategy has a relatively long history. And secondly, the dividend strategies has the performance that is very attractive in terms of the absolute term. Thirdly, we take a look at the overall performance of the funds in the recent year. And from our point of view, we say that the dividend strategy actually provides an investment with a very attractive risk and return profile. Thirdly, in terms of the performance, if we take a look at the funds in this peer group as a whole, we see that the performance of this peer group is actually higher comparing to the benchmark index. But on the other hand, if we take a look at the funds individually, we also observe a high variance on the performance number comparing to each individual funds in this peer group. The last point, regarding the quality criteria, for example, the financial strength and also the sustainable payout ratios, these quality criteria used by the active managers have actually resulted in a positive impact in terms of the protection of the value decrease and also the dividend drought. So this is all of the information from our study. For more information on funds information and risk return data and also information on webinar, please go to the scopeexplorer.com. Thank you. Barbara, I think you're on mute.
So yeah, before we move over to the Q&A session with the fund manager, I would like to say a few words about Guinness Asset Management. Guinness Asset Management is an investment boutique which was founded in 2003 and it's headquartered in London. It has 44 employees and it's completely owned by the employees. So for example, all the fund managers have an equity stake in the company. The Guinness Group focuses on high conviction, long-only equity management and manages around 4.1 billion euros in assets under management in these investment strategies. It has a focus on global equity, energy, including sustainable energy, and Asia. Fund manager Ian Mortimer, one of the two fund managers of Guinness Global Equity Income Strategy, has been with the company since 2005. He and second manager Matthew Page have been managing the strategy since its inception at the end of December 2010. So now I would like to welcome Ian. So hi Ian, great that we have you on board today.
Hi, lovely to be here. Thanks so much.
Thank you. So I would just start with diving directly into the Q&A session. So Ian, can you tell us a little bit about you and the team managing a dividend-oriented approach at Guinness? And of course, also what the idea was behind setting up an income-oriented strategy.
Yeah, absolutely. I guess in terms of sort of people and process, I'm not sure if do I share my slides or is that something?
Yes, sure. I can open them for you and just click forward.
Great. Yeah. So if you maybe go to the next slide, you can see the managers. So that's myself and my colleague Matthew Page. And you rightly said, I've been at the firm since 2006. Matt's been there since 2005. And ultimately, when we were designing this product, because this is a fund that myself and Matthew sort of designed from scratch, so it was basically our idea, we were really thinking kind of coming out of the financial crisis, thinking about how we might be able to create a portfolio that could maybe weather kind of most economic storms, particularly the difficult ones, and the types of companies we may want to invest in to kind of achieve that. As we developed our idea, we started to think about ideas such as return on capital and the persistency of that particular measure. And what that led us to actually was very interestingly, by looking for quality businesses, we found actually also companies that paid a dividend. And then many of these companies were able to not just pay their dividend, but grow it. And that's a key element of what we're looking for. Dividend growth, we think, is a very important aspect of what we're trying to achieve. And I'll talk about that a bit more in terms of our investment process. But ultimately, we launched this fund at the beginning of 2010, the end of 2010. So we've now got just over a 10-year track record in the space. We've been consistently the managers since launch, pleased with the asset growth. And if you move on to the next page, you can see also that we're actually supported by 2 dedicated analysts, so we're a team of 4. And I'm pleased to say, actually, within the last week or 2, we've actually added a 3rd analyst. So we're now a team of 5 looking at this strategy. But if we go on to the next slide, I can talk a little bit about more detail about the kind of fund philosophy, if you would like, or I'm quite happy to revert back to you, Barbara, if you want to take it any other way.
Okay, thank you, Ian. So yeah, we should go to the next question regarding the investment approach. So you are following an active approach, and you focus not only on the dividend yield, but also on the quality criteria. So could you please explain to us a little bit on how your investment approach works? And why is it important for you to choose the quality criteria in the investment strategy? And also, what do you look when you are choosing a company to be included in the portfolio? And preferably, maybe you can give us one example on the company to just for the illustration purposes. Thank you.
Yeah, thanks very much. Yeah, good questions. I mean, I sort of alluded to a little bit at the beginning, but maybe before we go into the actual sort of philosophy of the fund, if we take a step back, we might think a little bit about why you might buy a dividend strategy in the first instance. So what we're strong believers on, and I think there's a lot of evidence to suggest, is that companies that pay a dividend as a factor outperforms over the longer term. So much like value as a factor is being shown to outperform over the longer term, or growth. Dividend paying equities tend to, again, over the longer term, do quite well and beat the market. However, when you look at that in more detail, what you find is that not all dividend paying companies are created equally. And in fact, if you're a company that pays a flat dividend over time, you tend to do about the same as the market. So don't outperform. If you're a company that pays a dividend, but actually that dividend is cut over a period, you tend to do really quite badly. So the market generally dislikes companies that cut their dividend. And in fact, it's the small group in the middle, those companies that not only continue to pay a dividend, but manage to grow it over time, that drive the long-term outperformance of dividend-paying companies as a whole. So the best place to start for any approach to investing in dividend-paying companies is to look for those that A, won't cut their dividend, and B, will be able to grow it going forward. What we have found, as I alluded to earlier, is that the factors that correlate most highly to that are based around quality. So often you see in dividend strategies, maybe historically, people would either look for things like payout ratios. Maybe you could look at the number of years the company's paid a dividend, the aristocrat type argument, as ways of identifying these kind of good dividend payers. But our research analysis shows that although they are useful indicators, they don't correlate very highly with future dividend growth. The factors that correlate most highly with future dividend growth are return on capital, the balance sheet strength of the business, and ultimately the starting dividend yield. So if you've got a more moderate yield, it's easier to grow it, you're more likely to grow it. If you start with a very high dividend yield, you'll start from a pretty difficult point from that perspective. So if you take all of that in mind, how do you find these dividend growers? That's why we start with quality, and it's why it's sort of number one in terms of our investment approach. We're looking for companies with long histories of high return on capital, and we're looking for companies that have strong balance sheets. That is the best place to start to find kind of consistent dividend payers and growth. We're then bottom-up stock selectors, and we believe, despite looking at the quality companies, you can actually find companies that are relatively good value. This then, hopefully, as Barbara was talking about, should allow us to find the potential of a multiple expansion alongside the dividend that we would receive. In terms of our dividends, I think it's important, to note that we're a moderate dividend yield portfolio. So our current dividend yield is around 2.5%, and we're looking to grow that consistently. I would note that in today's market, that's about a 50% premium to the MSCI World Dividend. So although it feels low, in context of history, I think on a relative basis, it's actually quite compelling. And the final thing is, what we're also trying to do is kind of avoid behavioral biases, trying to have a very structured approach to portfolio construction. We run a 35 stock, equally weighted portfolio, and ultimately we're investing over the longer term, therefore our portfolio turnover is deliberately low. If we then go to the next slide, I can just quickly talk to you about kind of our definition of quality. So I think when people say quality, I think it often means sort of blue chip, kind of the big businesses that you might recognize. But if you go on to the next page, you can see that what we mean by quality is actually we're looking for companies that have a 10-year history of a cash flow return on investment greater than 10%. So a very high hurdle to get over. There's only about 600 companies globally that actually achieve that, all of them 16 to 20,000 listed businesses. And then we're looking for that strong balance sheet. And I would note we only look at larger businesses, so we do not look at small cap companies. Our minimum market cap cutoff is $1 billion. And what that means is, if you go to the next page, in terms of sort of the market anomaly we're trying to capture, it is that ultimately If you think about the average business, you see it's the sort of company as I show on the top right. Generally speaking, you're investing to grow, you get that growth, you're creating value, and generally over time, competition comes into your market and that value creation ability is eroded. We're saying we can find these other companies, these good businesses or these quality companies that have shown some ability to avoid that competitive threat for whatever reason. Great management teams, they've got a better product, they're more efficient, higher margins, whatever it might be. And what's interesting to us is that although we are looking backwards, what is the history of this company and how has it done? We think this is a very good indicator of what the company can do in the future. So if you have this 10-year history, we find there's a 93% chance you're continuing to be that quality company in the following year, and there's an 80% chance you're still doing 3 years later. So there is a strong persistency in good businesses. And ultimately, the thing we're trying to capture is that these good businesses that we find are likely to remain good are often priced by the market like they're going to become the average company, because short-term market movements change market prices, and therefore companies can be misvalued if you're taking that longer-term view. So our job is to look from the bottom up, find these good businesses that are trading attractive valuations, and hopefully we can get multiple re-rating as the market comes around to kind of our way of thinking.
Thank you. So since you mentioned regarding the equally weighted strategy, our next question is regarding the idea or the spirit behind this strategy. Why did you choose to have this equally weighted strategy, and why did you fix the number of around 35 holdings? So could you please give us some explanation on this? Thank you.
Yeah, I don't have any specific slides on this, but I can talk to it. I mean, ultimately, in terms of the number of companies we look at, we think 35, pretty simply, gives you the benefits of diversification from a risk perspective, while also maintaining that kind of concentration of companies held to allow you to outperform time. So what we generally, I think most people would look at somewhere between 20 and 40 companies would give you that benefit. And we found that 35 works quite well for us. It means that each position in the portfolio is around 3%. And so in terms of sort of the number, I think that's sensible. Another element of having a fixed number though, so 35 gives diversification, having a consistently always 35, we think instills a strong sell discipline to our approach. So because we have a strict number, a set number of companies we will own, we're always having to think about what to sell to create space for something we want to buy. So that means we're constantly thinking about creating a portfolio of our best ideas. You will not see it change to 36, 37, 38, 40, 50, 80 companies as our assets grow. It will remain at 35. In terms of the rebalancing process, the equally weighted nature of the portfolio, I think there's many aspects to this. The first aspect is it does limit stock-specific risk. So although we have a sort of target weight of around 3% from a sort of theoretical equally weighted perspective, we do allow our stocks to move, and whether they're the share price is rallying or maybe it's underperforming. So we give ourselves some flexibility to sort of let our winners run, if you like, or not necessarily kind of water the weeds on the other side. However, what you will not see is position sizes going to the 5, 6, 7, 8% of the portfolio. So we think by keeping that weighted portfolio, it limits stock-specific risk. It also means, again, thinking about those behavioural biases, it forces us to do what we should be doing. So if you have an equally weighted portfolio and the stock has underperformed, you think about adding capital back to that stock to bring it back up to weight. That makes you think about the stocks that maybe underperformed. If you don't want to add capital at that point, that's a very clear indicator to us that maybe you should be thinking about selling that position. Equally, if the stock has rallied, it means you can't just fall in love with the company. Generally speaking, if the stock rallies, it's getting more expensive. So rather than owning more, you should probably want less. Index problem, if you like. And again, that sort of instills that good discipline. By also taking advantage of short-term market movements through that rebalancing process, we do think we can add value. So research we've done looking at the rebalancing process shows, is a very powerful tool when markets are very volatile to make you do those decisions at difficult times. So just looking back to say 2020, for example, we saw Pacific market sell. We were kind of working through the stocks that underperformed quite significantly during that period, doing the work, trying to figure out if there's anything fundamentally wrong, or actually, that longer term these stocks would be okay, and then sort of thinking about and adding back to those stocks, ideally nearer the bottom, which means as those stocks rallied, then actually we captured more of that upside. And again, that rebalancing process can be very positive in periods such as that. The final thing I would say on it is, when you look at what we believe is good performance of the strategy, you should be happy that it has not come from one or two big stock positions that happen to do quite well, and maybe we could or could not repeat that. For us, it's all about the repeatability of the process and the scalability of that going forward.
Thank you very much, Ian, for leading us through the strategy. And I just wanted to point out the key points to our investors is that you have limited yourself to your 35 best ideas to reflect your highest conviction positions, but you have chosen to equal weight them to limit stock-specific risk and also do regular rebalancing to have like little contrarian element, adding to the stocks that have lost most and top slicing the positions that have done best, which has proven to be beneficial for investors over the long run, and also that it's like a discipline when you want to add a new position to the portfolio that you have to sell another one. I have another question about the portfolio before we move on to performance and dig in deeper into the fund's performance and the market's performance, which is a question sector allocation, because usual suspecting dividend fund has relatively prominent weightings in sectors like energy or utilities, because they usually have high dividend yields. But I haven't found these sectors in your fund. So I'm suspecting it has to do something with your quality criteria. Can you speak a little bit about why you are a bit different to the sector allocation of the common dividend fund and what your reasons are?
Absolutely, yeah, that's a great question. Thank you. Yeah, and I think if you go to my next slide, I think this sort of tells the story, and you're dead right. It is all about our process in terms of the quality factor. Because as you rightly say, if you took the approach, which I think many funds do, and often that's how income funds were ran previously and historically, you would screen for dividend yield in the first instance. So you would find all the companies with the highest dividend yield, and you'd kind of work through to figure out which ones you thought were the best value. And then, hey presto, you've got this portfolio that has a high dividend yield. We never really thought that was the best approach. And that really, again, comes down to that dividend growth is what you want, not just the headline yield. Because actually, you can catch up quite quickly. If you start with a lower yield, but you grow fast, you can catch up quite quickly with the company that has a high yield that's growing slowly or not at all. And it doesn't take too long to achieve that. And ultimately, we think that you will, alongside, get the capital growth, which will come through alongside the dividend growth, because ultimately companies only grow their dividend if they themselves are growing, if you want to do it sustainably, and therefore we think that is a very positive thing. But to your point, if you screen for a persistently high return on capital, that will exclude certain sectors. So this chart I'm showing you is not the fund, this is our investable universe, so what we could select from. And it shows it going all the way back to the year 2000, because we can imagine what the potential selection of companies we may have been able to choose from at that time. So pre the launch of the fund, but gives you a good indicator. And what this shows is areas such as sort of utilities, REITs, the kind of regulated areas of the market, generally do not pass our screens because they are not allowed to earn that high return on capital. If you're a utility and you're making significant profits on a high return, generally speaking, the regulator will come in and say, no thanks, you need to lower that back down, and that's in the benefit of sort of wider society. Similarly, if you take the very cyclical areas, the kind of commodity stocks, the kind of energy and materials, again, if you're very cyclical in nature, you again don't tend to have that persistent nature of the high return on capital. You may own very high returns in some periods, but that will be offset by other periods where it will be very low because it's kind of outside of your control. It depends what the oil price is doing, or the copper price, or the iron price, which is not really being driven by the company and can't control them. And so within our investable universe, areas such as utilities, REITs tend to be the high dividend yield places, and things like commodities, again, tend to be pretty low. And then the other thing I would note is within our financials exposure, it generally, again, the banking sector does not tend to come through. Because again, it's sort of, you know, the types of kind of returns we're looking for do not tend to be met by those businesses. So actually, there's sort of 5 areas that you would generally see as very high weights in your traditional high yield approach that are actually very low or zero weights within our so very low weights within our investable universe, and often zero weights in our portfolio. So over the last decade, we've never owned a utility, we've never owned a REIT, and we never owned a bank, we never owned any companies in the materials sector, for example. I think that's right. It's very different to, you know, many other approaches. However, there's a very good distribution across lots of other sectors. So although we're looking for this persistent high quality, it does not mean we can't buy cyclical areas. You know, industrials, consumer discretionary, other financial service type businesses, IT companies, all come through our approach, but they're just either not as cyclical or not as regulated.
Thank you very much, Ian, for your explanation. Before we take a closer look on performance, I would like to touch on recent developments of dividends. So how have the dividend payouts developed maybe shortly after the COVID crisis, and which have been the sectors that have been hit the hardest by dividend cuts, which we have learned have a high influence on the stock price. So if a dividend is cut, the stock price plummets. So this is really something you would like to avoid in your portfolio. And I also wanted to ask if you have seen a recovery so far in 2021, and how strong was it? And maybe was it different in different sectors?
Yeah, absolutely. Yeah, I think you know, if you're thinking about dividend investing, you know, 2020 was an incredibly difficult year for dividend investments. You know, probably definitely the most difficult time I'd seen, and I think if you looked historically at markets, it would have been one of the worst times specifically for that sector, beyond, you know, things like the financial crisis, which, you know, again affected a wider berth. And I think what you saw was various things. So firstly, you saw highly regulated areas being forced not to pay their dividends. So things like the banking sector in particular. You saw areas where businesses were most affected by what was happening in terms of the COVID crisis, whether it's you know, airlines or cruise liners or anything else performing poorly. That makes kind of sense. But also you were seeing companies with weaker balance sheets doing quite poor from a dividend perspective, because the market was saying, hey, I'm really worried about, you know, this economic sudden stop. I'm going to look for companies with weak balance sheets because I think they are quite likely not to be able to pay their dividend, because they're going to need to use whatever cash they have available to them to actually kind of maintain their debt profile. So there's lots of things going on, and what that meant ultimately, if you go on to one of my slides, is that you saw significant dividend cuts at the index level, and that was through, you know, it was quite concentrated in certain sectors, as you said. So I think things like the banking sector, things like the industrial sector, for example, kind of consumer discretionary, for example, many of these areas were hit very hard from that perspective. But one way, you know, beyond looking at the index payout, that we can consider is what the dividend action was. Because when you think about the dividend index, the dividend from an indexes are not equally weighted, right? They're market cap weighted. So if you have a very large company that cuts its dividend, that's going to have a bigger impact on the overall dividend distribution of the index. So it can be helpful just to look at just the number of companies and what they did. So this chart on the right showing the dividend actions for the S&P 500, the Euro Stocks, the FTSE 100. And it's just showing you how many companies grew their dividends, how many companies kept their dividend flat, how many reduced or cut their dividend, and how many completely cancelled them. And what you can see is if you look at the green and blue bar, that's the Euro Stocks and the FTSE, you actually saw 50% approximately of companies either cut their dividend or completely cancel it. So significant changes from the dividend landscape for these two areas. In the S&P, we did not see that as significant, as significant cuts or cancellations, because in the US they're kind of buffeted by the buyback. So in the US, from a tax perspective, a lot of companies do buyback alongside their dividend. So a lot of companies were just cancelling the buyback, and that would then allow the dividend to kind of continue to be paid. However, pleasingly in our portfolio, we were really pleased to see actually the kind of the dividend actions across our portfolio in 2020 be very different to the benchmark. So of our 35 companies, we actually saw 28 companies grow their dividend in 2020. So a significant portion of our portfolio actually came through this, not just well, not just okay, but actually really well. They continue to grow their dividend. We had 6 companies that were a bit more conservative, kept their dividend flat. We only had 1 company reduce their dividend, and we didn't see any complete cancellations or suspension. So when we compare that even to something like the S&P 500 that was better placed, we found that our quality approach, the types of businesses we're owning, really fared extremely well from a dividend perspective. To your point about the dividend growth and what we're seeing now, if you go on to the next slide, you can see here some charts from SocGen put together, showing you those initial reductions in the index payouts. So Euro Stoxx down about 33%, FTSE down 33%, S&P sort of flat, and then Japan we saw a small reduction. But I think what's key is if you then put in consensus estimates for what that dividend is going to look like, we are not seeing across the board recoveries. So yes, some companies are reinstating their dividends, that's great, but actually overall, I think a lot of companies, particularly in Europe and the UK, have reduced their dividend and are maintaining that low level. As in they were it was better for them to do it. They're either still struggling or they would just prefer to have that lower payout, and they've managed to do it alongside lots of other companies and maybe not as punished. So if you look at the expectation, even by 2022, probably more like 2023, 2024, maybe even 2025, in Europe and the UK, you might just get back to the dividend you paid in 2019. So you've got sort of 3 or 4 years, essentially much sort of lower levels of income distribution than we had seen previously. Although the headline dividend growth from 2020 to 2021 will look very strong, it's starting from such a low level. That's the thing you need to be very cautious in. And if you go on to the next slide and think about where we are in terms of our portfolio, we've seen most of our companies report what they're going to do with their dividend this year. So the dividend actions we're seeing is we've still got 26 companies who've grown their dividend. We've got 2 flat. 1 company, which was Danone, reduced their dividend slightly by about 7% and in line with earnings decrease. No cancellations, and we've got 6 companies yet to announce. And we feel pretty confident those 6 are either going to maintain or grow their dividend. So we're starting from a level where essentially we kept our dividend flat for the fund over the year, and that we're going to sort of potentially grow it going forward. So if you go to the next slide and you look at what our fund dividend yield looks like relative to the benchmark, you get that sort of 50% premium. So historically, we've run the fund to have a dividend yield premium somewhere between 10 and 20%. This is just going back to 2016. But more recently, we've seen that spike up because the dividend, the index level has got cut. We've maintained our dividend, and then that differential is continuing to be maintained. And we think that's very sort of positive in terms of our portfolio on a relative basis to the benchmark.
Thank you, Ian. So considering what we mentioned just now, I would like to ask one question that was there any reallocation on the asset in the portfolio due to the impact that caused by the COVID, which is unforeseeable?
Yeah, absolutely. So I mean, when we we made 3 changes to our portfolio in 2020. I think we did these relatively quickly in terms of what was happening from the COVID crisis. So when we were sat in our offices, seems like a long time ago, but we were back in February, we were looking at kind of this virus coming across from China into Western Europe and the States, becoming a serious issue. I don't think we necessarily fully understood the implications of what was going to happen, or how deep and then how quickly the recovery was going to occur. But what we did do is we looked very carefully about what we owned and said, things have changed. What do we need to reassess in terms of our portfolio? So we sold a company, energy space, which was Royal Dutch Shell. Just felt that the oil price could come under pressure if demand shrank, which we thought would be very likely. We sold a company called WPP in the UK, which is a global advertising business. It had its own issues coming into the crisis, but ultimately we felt that, again, advertising spend would be probably lower, and generally they're not a good place to be in a kind of more recessionary environment. And then thirdly, we sold Randstad, which is a global recruitment business. Again, going into a recessionary environment potentially did not seem like a good thing to be. And ultimately, we did very well from selling those quickly because those stocks did underperform quite significantly in the crisis. But ultimately, they also did then go on to cancel their dividend. So Royal Dutch Shell reduced their dividend by 2/3. WPP completely cancelled it, and Randstad completely cancelled it too. In their place, we bought Pepsi, a global consumer goods business. We bought Medtronic, which is a global medical devices business. And then thirdly, we bought Otis, which is a lift and elevator business. All happened to be in the States. So we kind of sold 3 European companies, bought 3 US companies. That was more where we're finding opportunities rather than a particular asset allocation. But ultimately, it was a trade of thinking about maybe upping the quality, upping the balance sheet strength, upping the likelihood of receiving the dividend, but maybe having to pay a slightly higher price for that at the overall portfolio level from a valuation perspective. We felt that was sensible relative to the things we were selling. And so they were the 3 changes we made. We didn't make any other further changes through the period. Although what we did do, as I mentioned earlier, was rebalance the portfolio through the summer and into the kind of the third quarter as we started to get a bit more information about what was sort of happening. And again, those sorts of decisions, topping up companies like Aflac, which is the US insurance business that also has a big Japanese business as kind of direct to consumer through the post office. So therefore that business sort of really shrank very dramatically. It underperformed significantly. VF, which makes bands, trainers, North Face jackets, again, that did very poorly. But if you took a longer term view, we felt they were still well-run businesses, and ultimately we were buying more of those at lower prices as we went through, as I say, sort of the late second quarter. And hopefully that added quite a lot to our performance going into the end of the year as we saw that recovery trade come through.
Thank you. So the next question regarding the risk-adjusted return. Like we mentioned just now from the result from our study, the Guinness Global Equity Income Fund has the top-tier risk-adjusted return, which means that for every single unit of risk that you included in your portfolio, you managed to achieve a higher return compared to the majority of the other funds in this peer group. So could you please share us about what is the secret or how did you manage to do this?
I can't tell you the secret, Runchao, otherwise you'll all be able to do it for yourselves. I guess really, the way we're approaching in terms of our investments in this portfolio, because if you go back to the beginning and think about that quality idea, we generally are expecting this approach to do best on a relative basis when markets are very weak. So it should be quite defensive on the downside in terms of protecting through the quality businesses and the quality businesses, better balance sheets, and generally avoiding some of the most cyclical areas. And ultimately, it's a dividend fund, which you might expect to have that characteristic. I guess the difference is because our approach to quality is a little bit different to that kind of blue chip type argument. We can buy companies in areas such as industrials or IT or consumer discretionary that are more economically sensitive, yet still have those quality characteristics. So what that's allowed us to do then, I think, is to capture maybe more of the upside than you might expect from a kind of quality type dividend strategy. And I think it's that balance that we're always trying to achieve. The mixture between the kind of defensive area and the quality cyclicals, having a kind of quality overlay across the whole thing. So I think if you go to my slides, you can just see how that plays out in terms of sort of the overall performance of the fund. So I think we go on 2 more slides. So this is the cumulative performance of the fund, pleasingly well ahead of our sort of peer group, which is a bit more UK biased, I'm afraid, in terms of where the funds are listed. I mentioned Scope or broader base kind of group, but ultimately the red line is the MSCI World. Excuse me, the fund. The grey line is the MSCI World, and we've actually done really well keeping up with the market that has risen very strongly over the last decade. But what you can see is I've circled 2 periods, 2011, 2018, where we saw negative performance from the benchmark, and in both those periods, the fund actually outperformed. And that's sort of pointing towards that sort of defensive nature, and that's for quite different reasons, right? You had 2011's European crisis, 2018, various elements going on, but China growth worries, I think, at the beginning of that year. And looking a bit more detail about that drawdown analysis, if you go to the next slide, you can just see this is now just the MSCI World. It's a total return in just US dollars, just for clarity. We see that actually, although it's a very positive period for equity markets, there have been quite a lot of drawdowns, and we identify approximately 1 per year. And if you go on to the next slide, you can see what those were. So the first one, as I mentioned, is the kind of European crisis. The second one in 2012 was US credit rating downgrade. Third one was the taper tantrum in 2013, and so on and so forth, all the way up to the coronavirus last year. And you can just see in terms of our fund, it actually outperformed in each and every one of those periods. And what I would note is there's certain periods there where actually a dividend fund typically wouldn't do very well. So number 3, the taper tantrum, and then number 7, the kind of inflation concerns that we saw at the beginning of 2018, obviously the US wage growth spike up. Both those periods were essentially periods where the higher dividend yielding parts of the market led the market lower because the market was worried about interest rate risk, interest rates rising faster than we expect. Kind of those bond proxy type stocks, higher duration equities, whatever you want to call them, generally underperform. Whereas our fund actually managed to outperform. I think that's sort of pointing towards our moderate dividend yield approach and our dividend growth characteristics, meaning that although we're an income generating asset, we maybe don't suffer quite so much of that kind of interest rate risk on a relative basis to maybe some of our higher yielding peers. I think that's very important today to be thinking about what might be occurring in the markets as we go into 2022, 2023 and beyond. Clearly last week, last Friday, we saw the Fed just change what they were talking about a little bit. Maybe we'll start talking about interest rate rises. We might bring all that forward a little bit, and then we saw very different markets that we've been seeing in terms of that inflation trade. And again, I think if you're holding income generating assets, our sort of approach I think is a sensible one. Next slide, though, if you think about slightly more positive times, so rather than when it's all going to be terrible and markets are going to sell off, there are periods where markets have very expansionary. And I've just circled another 3 here: 2013, 14, and 2019. Periods where the market actually rallied really quite significantly, almost 20% euro terms for each of these. And what's pleasing is you can see that generally speaking, our fund held up pretty well. So maybe we underperformed a little bit, 1 or 2%, 2014 or 2019, but actually having the ability to keep up with those rising markets really adds a lot of value too in terms of our strategy.
Thank you very much, Ian, for walking us through the risk metrics of the fund. So you already answered my next question about the resilience of the fund in down markets. So thank you for that. One thing I found particularly interesting in your answer was that you touched on the bond proxy stocks in return or related to maybe the rate hikes we are expecting. So the next question leads us to our outlook, where we would like to ask you some questions about, and I would hand over to Runchao again, who would like to ask you the first question.
Great. Thank you. So yeah, the next question regarding the outlook of the market is that what is your expectation on the next 1 year development of the economy, and do you expect like huge recovery in the economics, or for the other points, is there any specific sectors that you would think that would benefit most from the next development in the next year? Yeah, so what's your idea on this?
A nice easy one, thank you. Just what's the market going to do in a year's time? It's very obviously we don't know, right? We don't set ourselves out to be macro investors who shift the portfolio based on the view that we think X, Y, Z will happen. We believe strongly, our bottom-up process, kind of quality businesses, is the best place to start, and ultimately over the longer term that will kind of come through. However, that said, we're obviously very aware of what's going on in markets from a macro perspective, and I think to kind of put in context where we are from our portfolio, the portfolio did very well during kind of the crisis of 2020, sort of when things were really bad. It kept up pretty well with the recovery, but ultimately that recovery was often driven by a lot of kind of high expectations, sort of hyper growth stocks, and for those kind of stay-at-home beneficiaries, if you like, which we generally would have no access to from an income perspective. They generally don't pay a dividend, so maybe that was different. We then saw in November the vaccine news, and then with the beginning of this kind of reflation trade with sort of either deeper value stocks or more cyclical areas, particularly things like commodities, rallying very strongly. We saw this kind of reflation trade kind of come through, and actually that coincided with some growth stocks maybe moderating somewhat in terms of their valuation multiples. They've got a bit ahead of themselves. Where that leaves you, though, ultimately, is that what sort of has maybe underperformed, what is maybe looking better value on a relative basis today. And I think what you could see is that the consensus of markets was extremely strong. Regards that reflation trade, whether it's things like when interest rates would rise or not, so the treasury yields spike up to sort of almost 1.75%, come down a bit. Expectations for inflation, whether it's on break even or otherwise, from sort of a market perspective, was very high. But what underperformed ultimately was things like the dividend as a factor. Things like quality generally underperformed because the market wasn't looking for that. They wanted high and fast earnings growth, and they looked for that to come through a recovery trade for maybe these stocks that have done pretty poorly, because they would have ultimately kind of the biggest relative earnings growth. And that if interest rates are going to rise, maybe my high growth stocks you have to discount a little bit higher because their kind of earnings a bit further away. I want kind of money now, if you like. But I think what we're starting to see is actually maybe that consensus break down a little bit. People start to think about actually maybe there is more uncertainty in markets in terms of that consensus not necessarily being as clear cut as it was. Whether that's third wave of the virus looking likely in Europe, for example. So maybe that kind of economic opening might stumble a little bit. So maybe it's not quite going to be as concerted or as broad based. I think clearly, as I mentioned earlier, that things like the Fed changing tack a little bit in terms of their kind of transitory inflation expectations and their approach to raising rates in regard to that. Clearly, they have a second mandate, which is employment as well, that is maybe not so obviously going to lead to kind of raising rates. And I think you're starting to see people looking once more at some of these kind of quality compounder type approaches. So I think I've got maybe some valuation risk and or interest rate risk in kind of high growth areas. I've maybe seen quite a big multiple re-rating in terms of my kind of cyclical and kind of reflation trade type stocks. Maybe what I think I'd quite like is stocks that I believe are likely to grow in a fairly consistent way. And if I could get some income alongside, which is now very difficult to find in any part of the market, whether it's fixed income or equities or alternatives, or real assets, then actually that is really our sweet spot for kind of what we're doing in the portfolio. Quality businesses, consistent cash flows, a really good dividend, which is sustainable and likely to occur. And now we're seeing relative valuations look pretty compelling. So the consumer staples sector, for example, generally trades at a premium to the broad market. So historically, it's always more expensive. It's got a better characteristic. Whereas now it's actually trading probably in line with the market. So on a relative basis, that's an area that's really quite interesting. And if you look at our portfolio, maybe if you go to one of my slides, you can actually see the portfolio today in terms of the portfolio positioning. That bottom right-hand number is showing our total portfolio trading on 18.2 times 2021 earnings, going to 16.7. That's at a sort of 14% and a 10% discount to the broad market. So actually our kind of quality approach is now trading at a pretty steep discount to the overall benchmark. And what I've highlighted here that I think has gone slightly askew, unfortunately, is that we've got about 50% of our portfolio within the defensive areas such as consumer staples and healthcare. We've got about 50% of our portfolio in those more kind of quality cyclicals. So we feel in our portfolio, we've got a pretty good balance, if you like, between the two areas. Things that might be more defensive, things that might have a bit more light. So although we're sort of hedging our bets somewhat, we believe this kind of quality approach overlying it all puts us in a pretty good position. And I think what the market's trying to wrestle with alongside that is just what stage of the economic cycle we're in. We've had the despair, the big sell-off. We've seen the kind of hope and the recovery with the big multiple expansion, not really associated with earnings. Now we're moving more into that mid-cycle or growth stage. I really want to see companies that can provide earnings growth that I can feel and touch and see, rather than those I expect in the future, or those that really need a very strong, broad-based economic recovery to come through to keep going. And I think that's what's breaking down on both sides, whereas hopefully we're sat a little bit more in the middle. And I think as we go into the back half, in the second half of this year, I think we're quite well placed from that perspective.
Thank you very much, Ian, for your answer. I have one other question about inflation and the outlook, and this is about the impact of inflation on the companies you invest in. So could you speak a little bit about how we evaluate the impact of inflation on your companies, and maybe also give us an example how you have considered this in your portfolio, please?
Yeah, it's a very difficult one because I think you can look historically how stocks performed in other periods of sort of inflationary pressure, but often those other periods will have other elements associated with them too. So inflation, but somewhat different to today's inflation. I think it's all really going to depend a lot on the magnitude of the size, the headline inflation number, but also how quickly that's accelerating. What the market doesn't like is sudden changes. So if you saw a big spike in inflation, I think that would be very negative for equity markets. But if you saw inflation rise gradually and relatively sort of slowly kind of growing, then actually that's basically telling you there's a good economic recovery occurring, and that would generally be positive for equity markets broadly. In terms of our portfolio, what we're trying to look at is companies that ultimately have pricing power. That's kind of how you would do best from an inflationary perspective. If you can pass on costs or higher costs to clients, then you can maintain your margins, and therefore you can generally be less affected by what's happening. But that's the sort of thing we're looking for. Companies that have already high gross margins, which kind of suggests they do have some pricing power, trying to kind of work through whether that sort of looks likely to be maintained. I think areas that could do well that we'd probably have lower exposure to would be those kind of commodity type areas that again would probably do well in inflationary environment. But what they wouldn't do for us is have that consistency of their return on capital that we're ultimately looking for. So that would be an area that could do quite well, but maybe we wouldn't have so much exposure to. But ultimately, if we can get that kind of pricing power question right, I think that again puts us in a reasonable position to be thinking about that. The other thing to note as well is what works best in inflation, things that can grow, right? So and again, having companies that can grow, and specifically the dividend growing, is very important in an inflationary environment. Generally speaking, index dividend yields grow probably as fast, if not faster, than inflation on a longer term view, and therefore that protects that distribution in real terms, which means whether you're thinking about it because you want to own the income to pay for your lifestyle, or at the end investor level, or you're thinking about it from a discount rate perspective, from a portfolio management point of view, that's also very important.
Thank very much, Ian, for your answers today, and also for sharing your insights about dividend investing. I think we could have gone on for hours speaking about dividend equities, but unfortunately, I think we have come to the end of the webinar. So I would like to thank you very much for being here today, Ian, to showing us your deep insights into your dividend strategy. And I think we had a lot of takeaways from you and from your strategy and what makes a good and profound and robust dividend investment strategy. I would also like to thank all of our participants that have been here today for your interest, and I hope you enjoyed our webinar. You can find the recording of all our Scope webinars, the upcoming webinars, and additional research, including a variety of fund information on our website, www.scopeexplorer.com. So I'm looking forward to seeing you in one of our next webinars. And now I wish you a great day and goodbye.
Thank you.